Hi, this is Martin Andelman from Mandelman Matters, and this is a Mandelman Matters video podcast. If you're watching this, I'm guessing you remember me from the last go around, the last time we had a giant economic meltdown back in 2008 through maybe 2014, 15. Anyway, I wrote the blog Mandelman Matters, and I wrote almost 1,200 articles on the political, social, economic, and legal aspects of the financial and foreclosure crisis. It's a big mouthful, I know. It's something I never wanted to do again, but now we find ourselves in the middle of yet another serious economic meltdown. And there's a lot of conversations going on out there about what's going to happen next. Will this be a V-shaped recovery? Will it be a W-shaped recovery? Will it be an L-shaped recovery? It's an alphabet soup of choices. In any case, there's obviously a lot we still don't know. When this started happening a couple of months ago with the advent of the coronavirus and so forth, I didn't really know what to say at the time. It was very confusing and totally unexpected. And I kind of wanted to wait and see what was going to happen. See, a lot of people started saying back then that this was going to be different somehow because of the way it started. It wasn't a real recession. It was really just a virus-inspired recession, right? You've heard that. It's not really an economic downturn, and it'll all go back to normal once the virus is under control. Well, I'm not sure that's really meaningful. And I'll tell you why. I don't really know. Once a snowball is going downhill and it picks up a lot of speed and it gets bigger, does it really matter how it started? Or if it was a fire in the forest and somebody started it with a cigarette butt in a trash can, does that really matter once it's burned 100,000 acres? So I agree, there's a lot we still don't know. But it's been almost 3 months since the virus and the shutdown took hold of the country. And I think there's a lot we do know. And I think now is the time to start looking at what we do know instead of continually focusing on all that we don't know. And that's why I'm here today, to talk about the economy, the state of the economy, and where we're headed from here. One thing I can tell you is this is going to hurt. This isn't going to be an easy one. We've lost around 40 million jobs, 40 million people unemployed. That's worse than the Great Depression's reported statistics, and it's not going to end anytime soon. That's number one. Number two is a number of other things are already changing. The jumbo mortgages are no longer being offered. The non-QM mortgages, the more unconventional mortgages, are already not being offered. Credit is being tightened significantly, and we're going to go over some of those numbers in a minute. The point is that now is not the time to sit around and say, well, there's everything we don't know. Now is the time to go, what do we know, and how do we protect ourselves going forward? So let's take a look at the numbers. So what's really happening? Well, what's happening is that investors, creditors, banks are concerned that people won't be able to make their payments going forward because of the economic downturn. And so they tighten credit restrictions. They make credit harder to get. And that often makes an economic downturn that much worse because people can't borrow the money they need to get through the crisis. So I've got some of the numbers right here. Let's take a look at what we do know. We do know that in the latest survey of comparecards.com, they surveyed almost 1,100 credit card holders and found that 1 in 4, 25%, report that their lenders have already either reduced their credit limits or canceled their cards. And that can happen. Credit cards don't belong to you, they belong to the bank. And if they decide that there's too much risk, they can unilaterally just reduce your credit limit. And that, of course, always happens at the worst possible time. HELOCs, home equity lines of credit, are the same way. The bank can decide to cancel it or reduce it anytime they want to. They don't need your permission, and they don't need any advance notice. So that's what a lot of people are starting to face right now. That's more than happened during the Great Recession in 2008. Something to think about. You see, during the Great Recession that started in 2008, it was 1 out of 6 credit card holders that reported a decline in their credit limit or canceling their card. We're already at 25%. And Bill McCracken, who's with the Phoenix Systems, that researches this sort of thing, said that if this drags out, it could easily be between 25 and 50% of people that see their credit limits cut or cards canceled. So that makes it harder to get cash when you need it, and it always makes things more difficult for everyone. So here's a couple of important quotes. Discover Financial, the Discover card, they issued a statement saying that they're going to ease efforts to issue new cards in a reaction to the recession. Ease the efforts. That means they're going to issue fewer cards. Synchrony Financial, which provides credit cards to companies like American Eagle, The Gap, Banana Republic, things like that, also announced that they are, quote, reconsidering credit limits of its customers by looking at their credit worthiness. So you see what's coming, right? Things are going to tighten up. Now, let's look at mortgages, some subject that's near and dear to all of our hearts. What's going on in the mortgage market? Well, it's a mess. Here's the mess. To give you an example, they're also tightening things up. JPMorgan announced this month that it's raised its minimum credit score to 700 and now requires a 20% down payment for most mortgages. Now, that means that people that do loans through JPMorgan have to follow those same rules. So it has a tendency to kind of carry through to other banks and other lenders. They've also raised credit score requirements for FHA loans, which usually would, people could get these with very low credit scores in the 500s with down payments of 3%. But many firms now are looking at scores as high as 660 at a minimum. So that's a big jump, and it's going to restrict people's ability to get FHA mortgages. Now, recent data from the Mortgage Bankers Association shows that 7% of mortgages are in forbearance. We're up over 4 million people that have contacted their mortgage company and said, hey, I can't make the payments right now. And they've been granted a forbearance. And we're going to talk about that in some detail coming up. Now, let's talk about HELOCs. Chase recently announced that it would temporarily pause issuing all new HELOCs. A couple of days later, Wells Fargo followed, announcing it would stop credit lines on April 30th. That's Wells Fargo Bank and JPMorgan Chase that are no longer going to do home equity lines of credit. Even if you could get one, they've become very difficult to get. Banks know that people may not be able to make the payments. They also know that home prices are likely to fall. Why do I say that home prices are going to fall? Well, it has to do with, obviously, the economic downturn, but you have to think about really what's going on. 4 million people are already not making a mortgage payment. Assuming that each payment is $1,000, that's $4 billion a month that is not being paid into mortgages. That means that servicers, your mortgage servicer, has to advance those payments. Now, the government's providing some sort of relief here, I assume. I mean, they're making some concessions, at least for Fannie Mae and Freddie Mac loans. But the reality is that that money's not being paid, and we don't really know when it will be paid or how that's all going to work out. And again, we're going to talk about that subject in some detail. But the point is that home prices are destined to fall. The thing is that home prices don't fall quickly. They never do. And the reason for that is that nobody ever puts their house on the market, say for $500,000, and then 2 weeks later lowers it to $350,000, right? That doesn't happen. The way home prices fall is that somebody puts their house on the market for, say, $500,000, and if nobody buys it that month, then maybe they lower it to $475,000. And if nobody buys it for a month or two, then they lower it to $450,000. And it takes time before a house sells in the neighborhood for, say, $400,000, and now the latest comparable is going to be $400,000, and prices are going to reflect a reduction in home values. So that's what's coming. The aggregate demand is down. We have 40 million people unemployed, 4 million not making mortgage payments, credit tightening, HELOCs being restricted, credit limits being cut. It doesn't add up for home prices going anywhere but down. What we're talking about is aggregate demand, the total demand for mortgages and housing. And it has to be down, right? I mean, with 40 million people unemployed and 4 million people not making a mortgage payment, just there alone, demand has to be down going forward, right? So think about things like no jumbo mortgages, right? Mortgages over $600,000-700,000 aren't being offered today. And that means that, say, if a house is $1 million or something like that, you now have to find either a cash buyer or somebody who's going to put $500,000 down. And there's simply fewer people that can do that. So it hurts demand, right? If FHA loans are harder to get, then a number of people can't get them and that also reduces demand. So all of these things play into home prices falling. You just won't see it for a while, right? It'll take some time, but you know it's going to fall. Non-QM mortgages, the unconventional types of loans, they're not being offered anymore pretty much anywhere, and that also will hurt demand. So we know that home prices are going to fall, and we also know that we may not see that for maybe a year, 6 months or a year, but it's going to happen. Look, let's understand, lenders have good reason to be concerned about the economy going forward. Take a look at these numbers. According to a new study just released by the National Bureau of Economic Research, a whopping 42% of the jobs that have been lost during this crisis are likely to have been lost permanently. They're not coming back. 42%. That's something like 17 or 18 million jobs that they're saying may never come back. It's got alarming implications, obviously. And even our Treasury Secretary, Steve Mnuchin, says that things are likely to get worse before they get better. Here's the quote: "The reported numbers are probably going to get worse before they get better," Mnuchin told the Fox News Sunday program. In certain states, it's worse than others. Obviously, real estate always has a regional or local kind of impact. In a place like Hawaii, let's look at Hawaii. Unemployment in Hawaii is now over 35%. The tourism industry has just collapsed. 35% unemployment. And they're saying it could get worse. Since March, the number of people flying to Hawaii went from 30,000 a day to 756. 30,000 to 756. It's unthinkable. It's an unthinkable drop. Now, let's take a look at this recovery target, right? People keep talking about, are we going to have a V-shaped recovery? Are we going to have an L-shaped recovery? Is it a U-shaped recovery? Is it a W? Like I said, it's an alphabet soup, right? But here's a quote from a leading economist. It says, "Those that are still hoping for a V-shaped recovery, a U-shaped recovery, or any sort of major recovery are all going to be deeply disappointed." Deeply disappointed. And people are saying, well, there's no solution to this crisis. I mean, this gets back to all the things we don't know, right? But we do know a lot, and none of it is particularly encouraging. So we need to talk about what can be done to protect ourselves if the worst does come to pass. Okay, so what can we do? Well, the first thing is, let's not be in denial. Let's not sit here thinking, hey, everything's going to bounce back next month or the month after that. It looks to me, and I think to most people, like we're not going to be living in a safe or normal world that we were used to just a few months ago until there's a vaccine. So this could go on for some time. And I'm not a doom and gloom guy. I'm not saying that the US economy isn't robust or that we're not able to turn things around, but nothing turns around quickly, and certainly nothing that has already gone this deep and made the cuts that it has. Keep in mind that the unemployment rate that they report is called U3, and it reports people that have looked for a job in the last 30 days. And if you were to add in the people that are underemployed, the people that haven't looked for work, the people that are working part-time, the self-employed people, if you added all that in, it's called U6. And the New York Times recently reported that U6 is running at about 27%. 27% are either unemployed or underemployed or part-time employed or whatever. Their incomes have dropped. And all of that is very real, and people are feeling it now and are certainly going to feel it more in the future. We still have the effects of some stimulus, some unemployment benefits and things like that that are propping things up. But as those things go on longer, that's going to be harder and harder to do. So what can we do? What can we do to protect ourselves? Well, first of all, let's talk about business people. If you're a small business owner, right? I think you have to take a look at going forward where you think you'll be. And if it looks like it could be a problem, then you may need to think about bankruptcy. You may need to think about filing Chapter 11. You may need to think about filing Chapter 7. You may need to think about filing Chapter 13. There are a number of choices there in different situations. But here's what I really want to tell people. Don't wait. If you're a small business owner and you're struggling now, and if you imagine, well, what if this goes on 6 more months? What if this doesn't return? Where will I be then? If you think that bankruptcy could become important, then my 2 cents is see a bankruptcy lawyer now. Don't wait. Don't wait until it's a crisis. I mean, you might be okay today, but if you think going forward that that could become a strategy that you need to use, then it's really important to get to that bankruptcy counsel, that lawyer now, because the earlier you do that, the better you can plan for it, the more choices that you'll have. If you wait until things are in crisis mode, the choices go way down, right? So you don't want to do that. You want to start being realistic and saying, what if things don't recover? What will I look like 6 months from now or even a year from now? And if I can't turn this around, would bankruptcy be a strategy that would help? Now's the time to talk to somebody about it, not once the house is on fire. Okay. Now there's another thing. If you're thinking of selling your home, okay, I happen to just sell one, closed on February 29th. Lucky, that usually doesn't happen to me, but I got lucky and did sell the house. But if you're thinking of selling the house this year, think about doing it sooner rather than later, right? Waiting will probably cost you money. So if you put your house in the market today, we're still seeing solid home values in most areas. And now would be probably better than waiting until the end of the year or into next spring or summer. So you might want to think about whether now is the time to put the house on the market, knowing that values are likely to fall. Now, there's other options, right? So we talk about this forbearance issue, and frankly, I'm going to do a whole piece on that you can see. I don't want to make this one too long. But there's some things that you need to understand. If your home value, if you agree and you know that it is falling, then now would be the time, if you want to pull money out of it, to try to do it. Now, it's hard to do with a home equity line of credit, but maybe you can refinance and get a lower interest rate. Rates are running around 3%. So if your rate is 4.5 or even 4.5, this would be the time to do it. Waiting is not likely to be an advantage. Okay. Now, for those of you that are over 62, you've heard me talk about, I hope, or write about the HECM, HECM, the Home Equity Conversion Mortgage. It's the acronym the government uses to describe its federally insured reverse mortgage program. The HECM has a line of credit available that is unique. Nothing else does what the HECM line of credit does. So first of all, the HECM line of credit, let's say that you were to open a line of credit and it was $200,000. It's guaranteed to go up every year by whatever the interest rate is plus half a point. So it could be 4 or 5% that it's going to go up every year. So if your credit line is $100,000 this year, next year it's $105,000 roughly, right? Nothing else does that because that credit line continues to go up every year regardless of your home's value. It doesn't matter. The house could go down in value next year, but your line of credit would still go up. The other thing is that a HECM line of credit doesn't have to be repaid on any certain schedule other than death or sale of the home. So now I do have to say you have to keep paying your property taxes, but you don't have to make a payment on the loan. You can pay it whenever you want to. So you could make payments every month or every 6 months or every year, or you could wait 3 years and then make a payment. It's totally up to you. Also, the HECM line of credit can never be canceled. Unlike a home equity line of credit, which, as we've said, the bank can cancel at any time, a HECM line of credit can never be canceled. It's there for life. Now, if you set up a HECM line of credit today and you're doing fine today and you don't need the money, great. Just let it sit there. It'll grow every year and it'll be there when you need it, guaranteed. The bank cannot cancel it. That makes it a lot better than a home equity line of credit. Also, with a home equity line of credit, you're going to have to, if you borrow the money, you're going to have to start making interest-only payments. And 10 years from now, you're going to have to either refinance that or have paid it off, or your payments are going to jump up. They become what's called fully amortizing. So you go from making interest-only payments to making principal and interest payments. And that can make your monthly payment go up by $500, $1,000 a month. oftentimes that's 10 years from now, 10 years later. And if you can't refinance the mortgage at that time, you're stuck having to make that payment. And people get into all kinds of problems with home equity lines of credit as a result. So now would be the time to tap that equity, right? As things get worse, credit restrictions could get more stringent and it would be harder and harder to do it. So I know that you might be okay today, but I just want you to look forward and say, well, what if this doesn't get better quickly? Where will I be and what can I do to try to insulate myself from that sort of situation? Okay, so that's about it for now. I don't want to go on too long. I've probably gone on a little long already, but I wanted to get those kind of important points across. And I hope you found it interesting. I hope you found it valuable. And I hope you'll keep tuning in to Mandolin Matters because there's a lot more to come. The blog's being redesigned. It's certainly past time for that. And I'm going to be interviewing some very important people, people that went through the last meltdown, helped consumers get through that. And people like Max Gardner, the consumer bankruptcy attorney extraordinaire who has trained so many thousands of lawyers around the country. People like Tom Cox in the state of Maine, Mark Dan in the state of Ohio. Some of the big names that, went through it last time. We learned a lot last time, and there's no reason not to benefit from that learning this time around. So until next time, this is Martin Andelman from Mandelman Matters. If you have questions, you can email me. It's right here on the screen, mandelman@mac.com. It's MANDELMAN @MAC.com. Email me your questions, and I'll be happy to try to get them answered either on the air by doing a show with a guest, or I could just respond directly to you. And as always, this is Martin Andelman from Mandelman Matters, and this has been a Mandelman Matters video podcast. Thanks for watching.